Now, with the COMEX silver market paper settled liquidity, alongside producer financing initiatives, all leaching out into the Chinese physical exchanges where they're properly benchmarked, silver has now largely escaped the LBMA stranglehold. Now, these same actors are having difficulty in containing silver. Now, the reason it hasn't spiked any higher is that the savvy buyers, the controllers, are in China, and they're sitting back and letting the specs and the paper market guys do their thing. They've got control. They can let this run to 50 tomorrow. They can let it run to 100 tomorrow. But it doesn't suit them right now. But it's coming.
For years.
What I wanted to do was I want to nail this once and for all. I want to actually really go dig into what's happening, how these end of month sell-offs are orchestrated, but also to illustrate how limited the scope of these constructive events are, and how constructive they are in themselves. And understanding them enables us to deconstruct this deliberately planted bearish narrative. We get it. We got to see it. Remember, Citi coming out and doing it. Hey, they've gone long now. Guess who was on the long side of all the shorts? Yeah. So it's a question now. Look, there's always a bearish narrative that either precedes or accompanies these events. And basically, we need to weigh up the paper to physical inflection points where bad actors dare not go. Now, outside the siloed world of the CME, LBMA casino, the strong, real physical supply-demand fundamentals are increasingly being determined outside the paper-settled LBMA CME ring fence. So each of these fiat gold selling episodes, one that we've just witnessed again into the end of the month, are simply consolidating the next in a series of higher physically supported stair steps. Each rinse cycle sucks more discounted fiat gold and silver into real physical exchanges. Now, to give an idea of scale of these end of month sell-offs and why they offer stacking opportunities, I'm going to seek to understand the myriad of these questions, asking how these sell-offs are generated. So using the most recent end of month paper-driven sell-off as a really good example, I'm going to drill down into the two factors that enable, but most importantly, limit the scope of these synthetically driven sell-offs. Now, we've been drawing a lot of attention to how the only tools left in the LBMA CME gold price suppression toolbox are failing and are ultimately leading to an imminent US Treasury gold price revaluation. Now, the scope of tool number one, which is the gaming of the COMEX exchange for physical premium. In other words, there's a COMEX price and it has a premium versus the Basel III compliant backdoor, which is usually as a lower price. So one starts off high and then they kind of marry together as the contracts expire. So I want to go through them because it really confuses a lot of people, and it really should be simple. And I think by using a chart, we'll look at how simple actually it is. Because what's happening is that this tool number one is essentially the COMEX market. We're witnessing the COMEX market, the exit of the liquidity, and that's going into the global physical delivery markets. And then there's a tool number two, which is just it's the in conjunction with this first tool. What you do is drag in, led by the nose, a dwindling number of paper market speculators, lead them by the nose to take the bait, smack into them. Let's look at both of them. And really the first one is the key. For those that don't trade futures, now it's worth just understanding that when a leveraged, unbacked futures contract for gold or silver moves into expiry, as the August contract just did into the end of July for delivery on the 1st of August, it loses all its premium, which is called contango. And then it trades at the same price as the deliverable spot Basel III compliant global facing foreign exchange market where it's possible to actually take delivery of a physical bar. Now, everything's going to make sense because as the August contract expires, it reached the same price as the deliverable contract. It makes sense because that contract just expired. So traders who don't want to be forced into taking delivery of their August COMEX longs or the shorts being demanded for delivery, they either exit or close and then roll further positions into the next liquid contract. In this case, it was the December contract, which at a rollover price that traded $59 higher premium to the deliverable spot contract. So that'll all make sense when we look at the charts. Now, the futures premium price over the spot price, what it does is allow for the carry costs. There's insurance costs, there's storage costs, etc., until the December contract goes into delivery on the first day of December. So obviously there's a period between August and December. But as a side note, given that gold is only fractionally held, the cost to carry is actually arbitrary. Yeah, with the physical silver trade now largely bypassing Loco London, we looked at this last time, these same actors in silver futures are still exposed, well, not just silver futures, but also to unallocated spot silver, are still exposed to these Office of the Comptroller, OCC derivative bets, which are being targeted for delivery by the physical markets and have become increasingly difficult for the Fed to cover. And this is evident by way of declining open interest, or let's say the number of chips in play. Now, with the COMEX silver market paper settled liquidity, alongside producer financing initiatives, all leaching out into the Chinese physical exchanges where they're properly benchmarked, silver has now largely escaped the LBMA stranglehold. Now, these same actors are having difficulty in containing silver. Now, the reason it hasn't spiked any higher is that the savvy buyers, the controllers, are in China and they're sitting back and letting the specs and the paper market guys do their thing. They've got control. They can let this run to 50 tomorrow. They can let it run to 100 tomorrow. But it doesn't suit them right now, but it's coming. Now, also, let's not forget, Russia is the 8th largest global silver producer and is estimated to produce about 1,400 tons of silver in 2025. Now, with the Russian central bank and the military complex recently diverting local production to stockpile silver, liquidity providers assess that this additional global offtake is not factored into the current supply-demand silver price, which is already in a deficit. And it is so disruptive, it tips the global supply deficit to force other competitive buying from China, India, and also from consumers who are going directly to the mines to produce, to source supply. Now, while spot silver is not Basel III compliant, it's important to understand this. Yes, it's not Basel III compliant, but it is a deliverable foreign exchange cross against the dollar, pound, euro, etc. And as with silver, and because silver supply is getting priced outside the LBMA's control, the Loco London Global Silver FX Fix, benchmarking the global physical supply demand settlement price, will have to rise to meet this fresh demand. And that's further going to drain Loco London's supply, which is already at critical levels. Now, the silver fix actually benchmarks a direct producer to end user price. And so any discrepancies are simply being arbitraged. And liquidity providers report continued accumulation of underpriced LBMA CME silver is currently now in the BRICS crosshairs, as it have been for some time, but it's stepping up. And very, very, very short term, silver under $38 is unsustainable. Yeah, so following on from our last episode, where we delved into the gold-backed tokenization and financialization of really potentially trillions of real-world assets, and based purely on supply-demand gap filling, this leads to a fair value price of 8,000 gold. And that is conservative. And as we recently indicated, silver well into the 3 digits. Now, while this tokenization gateway opens up every single commodity to be traded and settled intra-BRICS national currencies, we've been focusing on the West's gross underestimation of BRICS nations